China has responded to Trump's import taxes with a 34% retaliatory tariff on all U.S. goods entering China. One industry that could be hit hard is farming.
The prices have declined for the three major commodities that are facing us right now: corn, wheat, and soybeans are all down, and farmers depend on those three commodities to hold on to our farms. So farmers right now are facing really trying times, and the president is going to put a lot of farmers out of business like this.
In April 2025, a tremor far greater than any tectonic shift rippled through the arteries of global trade. Markets blinked, ports hesitated, and farmlands in the American Midwest braced for a storm. Midway across the Pacific, a cargo ship carrying U.S. soybeans was suddenly ordered to change course. By midday, trading terminals in Singapore flashed a quiet yet devastating message. China had abruptly canceled all U.S. soybean shipments, effective immediately. What followed was swift and surgical. Within hours, 2.4 million tons of soybeans were rerouted to Brazil. By sunset, over $1.1 billion in American farm contracts had disintegrated. This wasn't a mere skirmish in the ongoing trade tensions. It was a controlled demolition. And soybeans were only the fuse. This was not random. It was a message. 40 ships changed course. A multi-billion-dollar trade artery snapped like dry twine. This wasn't a logistical hiccup. It was a calculated stress test of U.S. economic resilience. Wall Street took notice. So did the Pentagon. Because when your largest buyer halts mid-delivery without hesitation, you're not just losing revenue, you're being evaluated. Bloomberg was first to report that China had canceled orders from three major American exporters, Cargill, ADM, and Bunge, citing strategic procurement adjustments. But the implications ran deeper. By week's end, Chinese buyers had secured the same volume, 2.4 million metric tons, from Brazil, paying over $1.1 billion, as confirmed by S&P Global data. That volume represented nearly one-third of China's usual monthly soybean imports. Officially, Beijing did not frame the move as retaliation, but its timing spoke volumes. It came just 48 hours after President Trump imposed $90 billion in tariffs on Chinese electronics, metals, and electric vehicle components. Economists warned this was not a warning shot. It was a pivot, a carefully engineered step to sever dependency on American agriculture. The consequences in the U.S. were immediate and measurable. According to USDA's April report, unsold domestic soybean inventories surged 13%, hitting their highest April level since 2019. Spot prices on the Chicago Board of Trade plummeted 8.2% in a matter of days, wiping out $470 million in commodity value in just 1 week. In Iowa, confidence collapsed. "We've been shut out mid-season, and there's no plan B," said Matt Dunn, a fourth-generation farmer from Des Moines, in an interview with the Wall Street Journal. "This isn't a trade dispute anymore. It's economic isolation." The American Soybean Association projected that China's exit could slash farm incomes by up to 18% this quarter alone. President Trump's March 10th tariffs were intended to pressure Beijing ahead of trade talks. Instead, China struck back at one of the few U.S. exports it still needed: agriculture. Soybeans weren't just a crop. They were the backbone of a $14.3 billion trade artery. And China had just severed it with surgical precision. As Chad Bown of the Peterson Institute noted on CNBC, China is hitting Trump's base, rural voters in farm states, right where it hurts. The USDA confirmed that farmers across 11 Midwestern states now face moderate to high insolvency risk due to canceled forward contracts. What began as a trade war is fast becoming a domestic political liability. But this story is not just about soybeans. It's about strategy. Brazil's quick response was no accident. It was preparation. From 2020 to 2024, Brazil expanded its soybean acreage by 21%, supported by over $11.2 billion in agri-infrastructure. Chinese state banks helped finance new grain terminals in Santos, improved freight corridors from Mato Grosso, and co-funded the Ferrocarril Railway, cutting transport times by 42% per Reuters. Bloomberg Intelligence estimates that Brazil can now supply 70% of China's soybean needs, offering looser GMO restrictions, more relaxed environmental standards, and stronger protections under BRICS trade pacts. Brazil's rise is not temporary. It is engineered. The timing of China's move was exact. March through June marks the U.S. soybean export peak, almost 40% of annual revenues. Canceling shipments during this window triggered a cascading sell-off, slashing prices at their most profitable point. China even paid a premium, $14 to $22 more per ton. The source from Brazil, according to Financial Times. Why overpay? Because in Beijing's eyes, short-term cost by long-term control. Officially, China cited phytosanitary concerns, fungal residue, and pesticide traces. But the USDA and WTO databases confirm no violations. U.S. soybeans continue to meet global food-grade standards, with contamination rates below 0.01%. Trade experts remain skeptical. There's no precedent for halting trade on safety grounds without inspections or warnings, said Andrew Tilton, chief Asia economist at Goldman Sachs. This wasn't about fungus. It was about leverage. China didn't start this pivot at the negotiating table. It began at the docks. In the past 5 years, China invested over $8.3 billion into Latin American logistics. Stakes in Brazil's port of Itaqui, a $1.2 billion expansion of the Northern Grain Corridor, and direct funding for railways that slashed transport costs by 35%. As of 2024, 64% of China's soybean imports flowed through ports and rail lines with direct Chinese investment, per customs data reviewed by Bloomberg. As one analyst from a Carnegie Endowment put it, China is no longer buying food. It's buying leverage. And soybeans were just the beginning. In the first quarter of 2025, U.S. corn exports to China dropped 29%. In parallel, China signed a 3-year, $2.6 billion corn deal with Brazil. In March, China's grain reserve auctioned off 1.2 million tons of U.S. corn, citing price instability and strategic rebalancing. Industry insiders believe the truth runs deeper. China no longer trusts the U.S. as a stable supplier. This isn't diversification. It's insulation. What happens when the pivot expands to wheat, sorghum, or further? HSBC's April report reveals that China now secures over 70% of its grain and oilseed needs through long-term contracts with Argentina, Brazil, Russia, and Pakistan. Meanwhile, U.S. agri-exports to China plummeted by 26% in Q1, erasing $3.2 billion in trade value. Some hope diplomacy could reverse the trend, but China's infrastructure investments and clear intent suggest otherwise. As Jennifer Harris, a former NSC advisor, told Bloomberg, this isn't just de-risking, it's disconnection. And the world is watching. China proved it could abandon a $14 billion commodity and replace it in 72 hours, without supply shocks, shortages, or domestic unrest. This wasn't a trade spat. It was a proof of concept. Now the question lingers in boardrooms and briefings from Wall Street to Washington. If soybeans were phase 1, what's phase 2? Could it be semiconductors, rare earths, or even U.S. treasuries? This is no longer a farmer's concern. It's a global reckoning.